California's housing market has long been a symbol of the American dream. From coastal mansions with ocean views to suburban homes nestled near forests, owning property in the Golden State once meant stability, prestige, and the promise of long-term wealth. But that dream is now being scorched, literally, by fire. Wildfires aren't just burning trees and towns, they're burning away the value of homes, pushing property prices down, and shaking the very foundation of California's real estate market. What would happen if the home you invested your life savings into suddenly lost value, not because of a crash on Wall Street, but because of smoke in the air and flames on the horizon? What happens when your property is no longer seen as an asset, but a liability, one that buyers hesitate to touch and insurers refuse to protect? And what if this isn't just California's problem, but a preview of what's coming for the rest of the United States as climate disasters intensify? For decades, California's housing market has defied gravity. Despite sky-high prices, people flock to the state for its booming job market, natural beauty, and cultural influence. But wildfires are shifting the equation. Neighborhoods once considered desirable are now branded as high risk. Buyers think twice before purchasing, lenders scrutinize loans more carefully, and insurers either raise premiums to unaffordable levels or pull out entirely. The result is a market under siege, where the flames of climate disaster are scorching not just forests but financial futures. Let's break down why this is happening. The first and most obvious reason is direct destruction. When wildfires sweep through towns like Paradise or Santa Rosa, thousands of homes are reduced to ashes. Property values in those areas don't just fall, they collapse. Even for the houses that survive, the surrounding devastation makes them less attractive to buyers. Nobody wants to live in a ghost town surrounded by blackened trees and empty lots. Recovery takes years, and in the meantime, demand plummets. But destruction is only part of the story. Even in areas untouched by flames, perception matters. If your house sits near a fire-prone forest or in a county repeatedly on the news for evacuations, buyers will discount the price. They see risk, uncertainty, and future costs. This climate stigma is powerful. It attaches itself to entire regions, making them harder to sell and lowering overall property values. Insurance is another major factor. A home without affordable insurance is effectively unsellable. Banks won't approve mortgages on uninsured properties, and buyers won't risk everything on a house that could vanish in the next fire season. As insurers retreat from California's riskiest zones, homeowners are left scrambling for coverage from the state's FAIR plan, which offers limited protection at much higher costs. That drives down property values further, as potential buyers factor in thousands of extra dollars each year just to stay covered. Financing challenges compound the problem. Lenders are wary of high-risk regions, especially when insurance is unreliable. That means fewer loans, tighter terms, and sometimes outright refusals to finance purchases. Without credit flowing, the market slows and prices fall. Homeownership, once a path to wealth in California, now becomes a risky bet many are unwilling to make. Then there's the migration effect. As wildfires intensify, more Californians are leaving. Families tired of evacuations, smoke-filled skies, and financial uncertainty are moving to neighboring states like Nevada, Arizona, and Texas. As demand declines in fire-prone areas, supply outpaces interest, dragging prices down. Meanwhile, the influx of climate migrants raises prices elsewhere, creating winners and losers across the broader US housing market. Developers and builders face dilemmas too. Constructing new homes in high-risk zones is increasingly seen as reckless. Local governments are pressured to restrict building permits, insurers resist covering new developments, and buyers avoid them altogether. That further limits housing supply in safe areas, creating a strange dual market, plummeting values in fire-prone zones and skyrocketing values in supposedly safer regions. But beyond the mechanics of insurance and financing, there's the human cost. Imagine spending 30 years paying off a mortgage, believing your home is your nest egg for retirement, only to discover it's worth far less because buyers fear the next fire. For many Californians, that's the new reality. Their greatest asset is eroding in value, not because of neglect or bad choices, but because nature and society's response to it has turned against them. This raises deeper questions. Who should bear the burden of falling property values? Should the state step in to stabilize housing markets in fire zones? Should taxpayers across America subsidize insurance for California homeowners, knowing the risks are tied to climate change that affects us all? Or should individuals alone carry the weight of living in beautiful but dangerous landscapes? The responsibility is complex. On one hand, homeowners choose to live in fire-prone areas, often drawn by lower prices compared to coastal cities. On the other hand, many communities existed long before wildfires became this destructive. People didn't move into danger zones. Danger expanded into their backyards as climate change altered the environment. Holding individuals solely accountable ignores the systemic nature of the crisis. Corporate negligence also plays a role. PG&E and other utilities have sparked deadly fires through poorly maintained equipment. When corporations cause disasters, the fallout extends far beyond immediate destruction. Property values across entire regions decline because trust in safety evaporates. Why would buyers pay top dollar for a home when they know the power lines overhead could ignite the next catastrophe? Politics is another layer. State and federal governments have long delayed action on climate, forest management, and urban planning. Underfunded fire prevention programs, weak building codes, and resistance to change have allowed risks to grow unchecked. Now, ordinary homeowners are paying the price in plummeting property values while political leaders debate and stall. The economic consequences ripple outward. Falling home values mean shrinking property tax bases, which hurts schools, infrastructure, and local services. Towns that lose revenue struggle to recover, making them even less attractive to buyers. It's a vicious cycle. Fires burn, values fall, revenue declines, services weaken, and communities become harder to sustain. At the same time, inequality deepens. Wealthier Californians can afford fire-resistant homes, private insurance, or even relocation. Middle and working-class families, however, are trapped. They can't sell without losing money, they can't afford higher insurance, and they can't easily move. Their wealth is tied up in homes that no longer guarantee security. This raises a haunting possibility. Could wildfires create a new form of housing segregation, where only the wealthy can afford to remain in risky but beautiful regions, while others are pushed out? If so, California's famed diversity and vitality could erode, replaced by hollowed-out communities divided by risk and wealth. There are glimmers of hope. Some communities are investing in fire-resistant infrastructure, from underground power lines to defensible space programs. Innovative building materials and smarter urban planning could reduce risks and stabilize property values over time. Government programs could provide subsidies for insurance or retrofits, easing the burden on homeowners. But scaling these solutions across California's vast landscape is daunting and costly. The bigger question is whether the housing market itself can adapt. Will buyers learn to factor wildfire risk into every decision, creating a new equilibrium? Or will fear of fire permanently depress values in entire regions, leaving California's real estate market fundamentally altered? Economists warn that without intervention, the downward trend could accelerate, especially as climate change promises more frequent and severe fires. So why are California home prices falling under the weight of wildfires? Because risk has become unavoidable, because insurance is vanishing, because financing is harder to secure, because buyers are leaving, and because the promise of stability has been replaced by uncertainty. A home is no longer just a place to live, it's a bet against the flames, and fewer people are willing to place that bet. This is not just a California story, it's a preview of what could happen anywhere climate disasters intensify. Hurricanes in Florida, floods in the Midwest, rising seas on the coasts, all threaten to reshape housing markets in the same way. California's wildfire-driven housing crisis is the first domino in a chain that could topple the American dream of homeownership nationwide. So as you think about your own home, your own investments, ask yourself, what happens when risk becomes the most important factor in real estate? What happens when the market no longer rewards location or design, but punishes vulnerability to disaster? That's the reality Californians are living, and it could soon be yours too. Thank you for watching. If this story gave you a new perspective on why home prices in California are falling under the weight of wildfires, Subscribe to Crisis Lens for more investigations into how disasters are reshaping society. Like this video, share it with others, and join the conversation in the comments. Do you think California's housing market can recover, or is this the new normal for a state living with fire?